Hello everybody. Today we are going to do International Accounting Standard 23 on borrowing costs. Now borrowing costs are nothing but the costs incurred on any borrowings that you do, right? That is any loans that is taken, etc. Now these borrowing costs can be used for multiple reasons. They can be for your working capital, they can be for your long-term requirements, they could be for construction of non-current assets, acquisition of non-current assets, etc. Right? So here we are going to study when you borrow an amount for construction of an asset, non-current asset. Now there are two definitions that you need to be familiar with. As per IAS23, borrowing cost is the interest and other costs incurred by an entity in connection with borrowing of funds, that is any loans that are taken. A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use. So basically a qualifying asset is construction of a non-current asset. Getting it ready for its intended use takes a substantially long time. Okay, so where these borrowing costs that you're going to incur on the acquisition, not acquisition, but let's say getting an asset ready for its intended use, construction of that asset, these costs can become a part of the asset, non-current asset. So these costs are allowed to be capitalized, but there are conditions attached to it. When can these costs be capitalized? So all these three conditions have to be satisfied. First is when costs are being incurred on the qualifying asset. Second, when interest is being incurred on when these costs are being incurred. Interest and other costs are being incurred. And third, work has already started on the qualifying asset. I repeat, when costs are being incurred on the qualifying asset, it could be material, it could be labor, it could be any type of cost that have been started or are being incurred on the qualifying asset. Secondly, the borrowing costs are being incurred, right? The interest is being incurred. And thirdly, the work has already started on the qualifying asset. Now, when all these three conditions are satisfied, you can start capitalizing the borrowing costs. But when will you stop the capitalization? The capitalization will be stopped when the asset is ready for its intended use, or maybe the work was suspended during a certain period for any reason. So whenever there is suspension of work, because automatically one of the conditions doesn't get satisfied. So whenever there is any suspension or stoppage of work, the capitalization will stop. And once the asset is ready for its intended use, the capitalization would stop, right? So this would be clarified by taking a small example here. A company borrowed 10 million on 1st January 2018 at 10 million per annum to construct an asset. The actual work on construction started on 1st March 2018. There was a dispute between the management and the employees, and the work was suspended for one whole month of August. The asset was completed and ready for use by 31st December 2018. What is the amount of borrowing cost to be capitalized? Now, if you look at this information, the company had borrowed 10 million from 1st January. But when are all the three conditions satisfied? The costs are being incurred, the work is being undertaken, and the interest is being incurred. All these three conditions are satisfied on 1st March. So, capitalization will commence only from 1st March 2018 because all three conditions are satisfied from 1st March 2018. So on 1st January you start incurring the cost, or you start incurring the borrowing cost, but the work has not started. Therefore, from 1st January to 1st March, you will not capitalize the interest. So for how many months is the work being done on the qualified asset? The asset is ready for use on 31st December 2018. So from 1st March to 31st December, that is 10 months, right? March, April, May, June, July, August, September, October, November, December. That is 10 months, right? But there is a hitch there. What have they said? During August, work was suspended. That means no work was done. So one of the conditions is not fulfilled. So during August, one was suspended. So that is 1 month. So what is the total duration? Total duration during which work was carried out, or all three conditions satisfied, it would be 10 minus 1, which is 9 months. Okay. Therefore, amount to be capitalized would be for 9 months, the interest incurred for 9 months. So let's calculate. It is 10 million, right, multiplied by 10%, and it is for 9 months. So 9 by 12 months. So you will get an amount to be capitalized of $0.75 million. This is how you calculate it. The borrowing costs are capitalized only during the period when work is being done, when costs are being incurred, and when borrowing costs or interest is being incurred. Okay. I hope this explains the concept of when do you start capitalizing and when do you stop capitalizing. Okay. Now let's take another example. A company has taken a term loan for 5 years of 10 million at 10% per annum. It also has a bank overdraft for 6 million at 8% per annum. It was decided to use some of the funds from the term loan and bank overdraft for construction of an asset. The work on construction started on 1st March 2018. A total amount of 8 million was used for the construction of the asset. The asset was completed and ready for use by 30th November 2018. What is the amount of borrowing costs to be capitalized? Now, in the previous sum, you had seen that the loan was taken or the borrowing was done for a specific purpose, that is construction of a qualifying asset. Now here, there are two sources of borrowing. One is the term loan and one is the bank overdraft. Now these funds are pulled in together and we don't know which amount is used from where. Therefore, to do the capitalization, we need to find out the weighted average cost of capital or the borrowings. So in this case, what we need to do is first find out what would be the interest rate, weighted average interest rate. So you have a term loan of 10 million at 10%, right? So what is the interest that you're going to incur here? 1 million, right? And then you have bank overdraft, which is for 6 million, right? 6 million at 8%. So what is your annual interest in this case? 6 million into 8%, 0.48 million, right? So total interest on the borrowing is going to be 1.48 million, and total, therefore, weighted average interest rate is calculated as 1.48 divided by total borrowing of 10 plus 6, that is 16 million, right? and we want it in percentage. So you get, and this multiplied by 100, right, that's 100. So when you do this calculation of 1.48 divided by 16 multiplied by 100, you get 9.25%. So your borrowing interest rate weighted average is going to be 9.25. So now amount to be capitalized would be, how much amount have you used? You have used 8 million. The interest rate that you will use is 9.25%. And how many months? The work has started from 1st March. Work is completed on 30th November. So it's going to be 9 by 12 months. So the amount to be capitalized is going to be 8 million multiplied by 9.25%, right? Multiplied by 9 and divided by 12. So you get an amount of 0.555 million as amount to be capitalized. So this is one variation that could be asked where no specific source of borrowing is mentioned, but the funds are used from various sources. So in that case, you will be required to calculate the weighted average cost of capital first, apply it to the amount used, and then that amount would be capitalized. I hope this is clear. Let's go to one last sum with one more variation in this case. Okay. A company borrowed 10 million on 1st Jan 2018 at 10% per annum to construct the asset. The actual work on construction started on 1st March 2018. The entity did not require the full amount immediately and therefore invested 4 million till 30th June 2018 at 4% per annum. The asset was completed and ready for use on 30th November 2018. What is the amount of borrowing cost to be capitalized? Now, first step is, we have already done a part of this. The amount of interest related to the work done for 9 months. Work is done from 1st March to 30th November. So amount of interest incurred for 9 months related to construction of the asset is calculated as equal to 10 million multiplied by 10%. This calculation we had already done before, multiplied by 9 by 12 months. Okay, so we had got an amount which was equal to 0.75 million, right? Now the variation or the twist here is that you do not require the full 10 million immediately. Therefore, the entity had invested it from 1st January to 30th June. Okay, so from 1st January to 30th June, they have earned an interest on short-term investments. Out of these 6 months, March, April, May and June, 4 months relate to the period during which the work has started, right? So short term, just a moment, short term investment income related to the construction period is how much? From March to June, which is March, April, May, June, 4 months. So interest received or earned during this period would be how much? Amount invested is 4 million. At what rate? 4%. And for how many months? I'm saying 4 months, right? So 4 by 12. Why am I taking 12? Because 4% per annum. So the amount of interest received is going to be 4 million multiplied by 4%. You get a figure of 0.05333, but I'm going to round it up to 0.05 million, right? So the cost of borrowing incurred for during the construction period is 0.75, but you have also earned 0.05 from short-term investment from the same funds which were going to be used for the construction. So amount to be capitalized would be net amount. Okay, so the net amount here is 0.75, the cost which you have incurred, minus 0.05, the interest which you have received. So your answer is going to be 0.70 million will be capitalized. So whatever income you receive in the form of interest, short-term earnings or short-term interest from short-term investments have to be netted off against the interest that you're going to pay, and the net amount will be capitalized. I hope this concept is clear. These are the variations that could be asked in the exam, and these are very, very simple. With practice, you will be able to master it, I'm sure. Okay, and the disclosures related to the borrowing cost is the amount of borrowing cost that you have capitalized during the period, and capitalization rate you have used to determine the borrowing cost. This is especially for the second example where the pool of funds, there's multiple sources of funds, and the funds are pooled in together, and you have to calculate the weighted average cost of capital. I hope this video helps you. Thank you so much.